Warren Buffett once bet $1 million that doing nothing would beat Wall Street's smartest hedge funds. He won. It wasn't close. Your retirement is riding on the exact same question right now, whether you know it or not. Everything you can possibly do with money fits on one menu, 8 items. Every single one has somebody selling it to you, except the boring one that keeps winning. There's no commission on boring. And the biggest threat to your money? Not on the menu. It's closer than that. Minute 13. 8 items, 8 verdicts, 17 minutes, all of investing. Bring a pen. Every investment on earth, every single one, is one of 3 moves. You own something, you lend something, or you bet on something. That's the entire universe. Stocks, bonds, real estate, crypto, your cousin's energy drink company. Own, lend, or bet. Everything else is marketing. And there's exactly one law in this whole business that has never been repealed. The bigger the promised return, the bigger the risk. Always. Anyone selling you the first half without the second half is describing a crime, usually one that's happening to you. So why bother at all? One word, compounding. Money you invest earns returns. Those returns earn returns. Then those returns earn returns. It's bamboo. Nothing happens for years, and then you can't see your neighbor's house. $1 invested at 25 does more work than $3 invested at 45. Same dollar, different amount of time on the clock. Which is why the single most expensive thing in investing is waiting until you feel ready. The market has crashed, crashed, and recovered again through 2 world wars, a depression, an oil embargo, a pandemic, and whatever 2022 was. Through all of it, the long, boring line goes up and to the right. So that's the why. Now the menu. 8 items. Some of them will make you rich slowly. Some will make other people rich quickly. Telling them apart is the entire skill. So every item gets the same treatment. What it is in one line, what it actually pays, who gets paid when you buy it, and a verdict. A stock is a slice of a company. Not a metaphor, an actual legal slice. The company makes money, you own a piece of the money. The company catches fire, you own a piece of the fire. When a private company sells slices to the public for the first time, that's an initial public offering, an IPO. You may have noticed a certain rocket company do this recently, the biggest one in history, run by, the name escapes me. I'm not trying to dodge the question. We made an entire video about it. What it pays. About 10% a year, on average, over the last century. The best long-run engine on this menu. The catch is the word average. Some decades it doubles. Some decades it does nothing and insults you on the way. Now, there are 2 ways to hold a stock. Investing, you buy good companies and wait. In trading, you buy and sell fast enough that the gains go to someone with better software than you. This gentleman averages 400 trades a month. His broker named a boat after him. He does not have a boat. And wherever traders are losing money, somebody is selling them a course about it. Oh good, Randy Lydiot. He's moved on to this now. Study after study, across multiple countries, lands in the same place. The overwhelming majority of day traders lose money. The broker gets paid per trade either way. Verdict. So, buy the company. Forget the password. A bond is an IOU with a suit on. You lend a company or a government your money, they pay you interest, and at the end you get your money back. Probably. Government bonds are called the safest investment on earth because governments can always print the money they owe you. A system that makes complete sense as long as you stop thinking about it immediately. One thing nobody explains, when interest rates go up, old bonds go down. It's a seesaw. New bonds pay more, so your old bond, the one paying less, is suddenly the last kid picked in gym class. What they pay, less than stocks, on purpose. Bonds are the thing that lets you sleep, while stocks do whatever 2022 was. Although, fun fact, in 2022, bonds had their worst year in modern history at the exact same time. The shock absorber hit a pothole. Verdict. Bonds are the seatbelt. Nobody brags about the seatbelt. Wear the seatbelt. Nobody has time to research 500 companies. So we invented funds, one ticket that buys you a basket of them. A mutual fund is the original version. An exchange-traded fund, an ETF, is the same idea, but you can trade it like a stock. And then there's the index fund. An index fund doesn't try to pick winners. It buys everything, charges you almost nothing, and goes to sleep. What it pays, the market's entire return, minus a fee so small you'll need the next act to understand why it matters. Remember the boring item I told you about at the start? This is it. The $1 million bet is coming. Verdict, minute 9. Real estate. You buy a building, a tenant pays your mortgage, and in 30 years you own the whole thing. That's the brochure version. The lived version includes a phone that rings at 2 a.m. about water, and the water is never good news. It's also the only item on this menu normal people buy with 5-to-1 leverage. Borrowed money multiplies your wins and your losses with perfect fairness. The bank, either way, gets paid. Grant Cardozo, everybody. Some things survive every market. If you want the real estate without the tenants, there's a REIT, a company that owns buildings and pays you the rent. There is a reason that sentence sells. And here's the number the seminar skips. Over the last century, home prices themselves barely beat inflation. The real return is the rent plus the leverage, which means the real return is a job. Verdict, a decent business and a terrible hobby. Buy it like a business or don't. Gold. 5,000 years as a store of value. It pays no interest, earns no dividend, and produces nothing. It mostly sits in a vault, being shiny, while civilizations panic around it. What it pays? Protection, occasionally, and long stretches of absolutely nothing. Buy it at the wrong moment, and the wait gets biblical. Anyone who bought at the 1980 peak waited 28 years just to break even. 28. There are mortgages shorter than that. Robert Krasaki has correctly predicted 40 of the last 3 crashes. His gold did fine. His blood pressure did not. Verdict? Gold is fire insurance. Own a little if it helps you sleep. Just notice that the people selling it loudest also sell bunkers. Crypto. Depending on who you ask, it's the future of money, a casino with extra math, or a religion with a ticker symbol. The honest answer is it's been all 3, sometimes in the same week. Bitcoin is digital scarcity. Only 21 million will ever exist. That part is real. So is the part where it moves like a toddler who just had an espresso. And here's the honest paradox. Bitcoin has been one of the best performing assets of the last 15 years, and it has lost more than 70% of its value 4 separate times along the way. Both of those are true. Most people's stomachs only survive one of them. Slogan Paul refinanced his condo at the top. He describes this as conviction. His lender describes it differently, in writing, monthly. He also sells sugared urine in a sports bottle. We're not going to talk about that. Verdict. A lottery ticket that has occasionally paid out. Size it like one. If it's more than 5% of your money, it's not investing, it's a personality. Options. Contracts to buy or sell at a set price by a set date. When professionals use them, they're insurance. When the internet uses them, they're a slot machine that emails you tax forms. What they pay? For buyers, usually nothing. Every option is a bet against a clock, and the clock always gets paid. The sellers collect those expiring bets like rent, which tells you which side the professionals sit on. There are people who make a living here. There are more people who fund the people who make a living here. Statistically, you know which group you're in. Verdict. Insurance or a casino, depending entirely on which direction you walk through the door. And finally, cash. Savings accounts, CDs, money markets. The appetizer everyone skips. It won't make you rich, but it's the only item that shows up instantly when everything else is on fire. 3 to 6 months of expenses lives here, non-negotiable. That's the emergency fund, and it's the reason the rest of the menu never has to be sold in a panic. What it pays? A guaranteed slow loss. Inflation quietly eats 2 to 3% of cash's buying power every year, the only certain loss on this entire menu. That's not a flaw, that's the price of oxygen. Verdict. You don't invest in oxygen, you just make sure you never run out. That's the whole menu, 8 items. Now for the part the menu never tells you, how to order without getting robbed. Time to open the envelope. In 2007, Warren Buffett bet $1 million that a plain index fund, the buy everything and sleep item, would beat a hand-picked team of hedge funds over 10 years. The professionals got every weapon on the menu: leverage, shorting, derivatives, genius. Final score, index fund, 125.8%. The best hedge fund, 87.7. The worst, 2.8. And it wasn't a fluke. The official scoreboard is called SPIVA, and it counts every professional stock picking fund in America. Last year, 79% of them lost to the index. Stretch the clock to 15 years, there is not one single fund category where most of the professionals won. Not one. The sleeping man was right. which raises a question with an uncomfortable answer. If the professionals can't beat the market, what exactly are you paying them for? I'm glad you asked. So is Sterling Fields. Sterling charges 1% of your money, per year, forever. 1% sounds like a rounding error. On $500,000 over 30 years, it's roughly $275,000. Termites also sound small until you go to sell the house. A target date fund rebalances itself and charges about 0.15. The advisor warning you against it charges 1. The math here is not subtle. Different asset, same guys. Now, 3 habits that do the actual work. First, diversification. Spread the bets so no single fire takes the house. Owning one stock is fine until it isn't. Like wearing white pants to a barbecue. Bold choice, irreversible consequences. Second, dollar cost averaging. Same amount every month automatically into the boring thing. Markets up, you buy. Markets down, you buy more shares cheap. It's the financial version of just keep swimming. Not exciting, technically correct. Nobody puts it on a poster. Third, leave it alone. The market already knows everything you read this morning. It read it before you did, in microseconds, with better lawyers. The efficient market hypothesis is academically elegant and personally devastating if you spent 3 years stock picking. What that means for your retirement, specifically, the difference between the boring portfolio and the expensive, exciting one isn't a vibe. Over a career, it's 6 figures. Your 6 figures. But none of that is the biggest threat. The biggest threat has been holding the menu this whole time. Your brain was built to outrun predators and find berries. It was not built to watch a number go down 4% and do nothing, so it does things. Fear of missing out. You buy because everyone's buying. Getting into a long line outside a restaurant you've never heard of. Sometimes the food is great, sometimes the restaurant is on fire and the line is people leaving. Loss aversion. Losing $100 hurts twice as much as winning $100 feels good. So people hold losers to avoid making the loss feel real and sell winners to feel something. Herding. The crowd feels safe. The crowd is how bubbles happen, and bubbles all run the same script. 1929. The market fell 89%. So many ruined brokers were rumored to be jumping from windows that hotel clerks, and this was a real joke at the time, started asking arriving guests, sleeping or jumping? Different era of customer service. 9,000 banks failed. That's the reason your deposits are insured today. They invented that protection right after the crash. After. The smoke detector went in while the house was still smoking. In the year 2000, the internet was real, the prices were not. The NASDAQ fell 78%. A sock puppet pet store went from a Super Bowl commercial to liquidation in under a year. 2021. A dying video game retailer rose 1,700% in a month because the internet was bored and angry at the same time. Some people got rich. They are not the people who told you about it. And when there's no bubble available, there's always a man with smooth returns. Bernie Madoff delivered about 1% a month, every month, for decades. Smooth is the tell. Markets are never smooth. The returns were fiction and the statements were printed down the hall. He died in federal prison, which his investors describe as a start. Or a boy genius in shorts. FTX lost track of $8 billion of customer money. The accounting system was, in part, a group chat. He got 25 years, where, at last, the only thing compounding is time. His cellmate had also invested. Now the number that ties this whole act together. Morningstar measures it every year. Over the last decade, the average fund returned 8.2% a year. The average investor in those same funds earned 7. Same funds, same decade. The missing 1.2% a year, about 15% of everything those funds made, wasn't taken by the market or the fees or sterling. It was lost at the exits. Buying the top, panic selling the bottom on repeat. The biggest threat to your money was never on the menu. It's holding the menu. So you know the menu, you know the traps. Last thing, where the food actually gets served, the accounts. If your employer matches your 401k contributions, that matches a 100% instant return. It's the only free money in finance. 1 in 4 workers doesn't take all of it, leaving about $1,300 a year on the table. That's seeing a 20 on the floor, bending down, picking it up, and putting it back because the motion felt undignified. The IRA is the do-it-yourself version. Comes in two flavors: traditional, tax break now, taxes later; Roth, taxes now, tax-free forever after. If you expect to be richer later, pick Roth. That's it. That's the decision people lose sleep over. Inside these accounts, trades aren't taxed at all. Outside them, hold anything a year or more, long-term capital gains rates, a much smaller bite. The wrapper matters almost as much as what's in it. And one warning label: if you're carrying credit card debt at 22%, you don't have an investing question yet. Paying that off is a 22% guaranteed return, the only guaranteed return on this entire menu that isn't a lie. Which brings us back to the bench. His name is Jack Stodgel. He's been here the whole video. He owns the whole menu, a little of everything, mostly the boring item.
He has done nothing for 17 minutes.
That was the strategy, 40 years of it. Buy broadly, pay almost nothing in fees, automate it monthly. Then do the hardest thing in finance: nothing. Remember the bamboo. You cannot make it grow faster by yelling at it. Grant yells, Randy yells, slogan yells into a camera. The bamboo does not care. Boring plus time beats brilliant plus panic. Every decade, somebody repackages the fancy version. Different asset, same guys, same math, same winner. 8 items: own, lend, or bet. The pros lose to the boring one. The fees are termites. The biggest risk drives your car, and the free money is still taped to the floor. Here's my question for the comments. Which menu item is most of your money sitting in right now? Be honest. Slogan, we'll know. And if you want to watch a brand new item get added to this menu in real time, a rocket company just went public at the biggest valuation in history, and the rules got quietly rewritten to put it in your retirement account. We covered the whole thing. It's on your screen now.